Welcome to the presentation Is It Deja Vu All Over Again, presented by Bob Glenn of RGAdvisors. Today's presentation is an update to a conference we held last year entitled Update to Economic Boom or Bust 2011. During this conference, we discussed extensively the problems of European debt and of debt throughout the world. Here we are mid-year 2012. Let's take a look at where we are. In May, we saw the markets decline after a rise from the beginning of the year. Now, if you'll follow my cursor, you'll see these little circles called peak. This is 2010, 2011, 2012. And you can see that the trend in all 3 years was up over January, February, and March, peaking sometime at the end of April, and then seeing a decline in March. So this is what a pattern of what's called seasonality, where there is a predictable pattern that occurs on a regular basis, interval basis, whether it be weekly, monthly, yearly. This phenomena of markets peaking on a temporary basis in April is called sell in May and go away, and has been a well-known Wall Street phenomenon for a long time. So many of you who have growth portfolios saw a rise in January, February, March, and then were disappointed to see a decline come in May. And the question becomes, is this going to continue? What can we expect for the rest of the year? The markets and the economy continue to be challenged by high unemployment. Unemployment rates that are exceeding 8% have been as high as almost 10. We're having slow economic growth. Corporate profitability is somewhat declining because of the challenges in Europe and worldwide. And we hear almost daily of the Eurozone crisis. I would dare to say that many who not even knew where Greece really is could today tell you all about Greece. It's a never-ending saga. And then, of course, in that background also is what's going to happen to China, Brazil, Russia, India, and the other emerging countries that the world is looking for now to carry us economically. We've been in this financial crisis since 2007, and I presume many of you, like myself, are experiencing what I call crisis fatigue, where statements go up, they go down, markets seem to just meander sideways, there is no sustainable pattern, and the expectation of portfolios rising every year, incomes rising every year, and home values rising every year appears to be over for the last several years. And of course, the question becomes, when is this going to end? And I'm not sure if anybody knows that. But certainly the fact that we do know is that all of us continue to get a year older as we go through this financial crisis. And we get closer to the day where we might need those funds, either for retirement, for health purposes, just to spend. And so I understand the frustration. The frustration is being experienced by governments, by investors, by workers, by real estate people everywhere. And, the frustration just makes you want to scream, right? Interestingly enough, while the markets were declining, this particular painting called The Scream sold for $120 million, which was the highest amount ever sold at auction for a painting. So I think what this is indicative of is a world feeling that when you look at everything and you review the news and the governments and everything that's going on, it makes you just want to scream. One of the premises in retirement is that funds, some portion of portfolios need to continue to grow even while you're receiving income or even while you're in retirement. This concept of being able to retire and convert all your money over to a fixed income type investment with no risk is something that just unfortunately does not exist anymore. It may have for our parents' generation, our grandparents' generation, but it doesn't today. With interest rates so low, some of them hovering around 1/4 to 1/2 to less than 1%, this type of strategy doesn't work. So in order to get return, in order to see your money go up in value, to keep up with inflation, to create a larger portion to be used down the road, some of your money has to be in growth. Well, what's going on here? The problem, of course, is that we're not seeing the growth rates. And in some cases, over shorter periods of time, we're seeing negative returns. So the question becomes, why do we continue to do this? Why should I stay in growth? Why should, I anticipate portfolio going up when nothing seems to be happening? And let's take a look at 3 reasons why. The first one, and I believe the most important, is longevity. A generation, 2 generations ago, people would retire and they would be dead within 2 or 3 years. This was the whole premise behind Social Security. That when it was set up, there was a belief that it would be a very short pay, and so that there was no reserves ever set aside. It has always been a pay-as-you-go system. Today, people are living 20, 30, sometimes 40 years in retirement, up to 1/3 of your life. I contend that the biggest risk is running out of money for anyone. It is not the fluctuation in the marketplace, because that's a sure thing. That's going to happen every day. But that's going to be you live too long and you run out of funds, and you're at a point in your life where you're not able to earn more funds. A growth strategy is the only way over a long period of time that you can build capital. Any other strategy, whether it be income, whether it be safety of principal, or some highly aggressive strategy, ultimately won't work. So we remain in growth for the longevity. And the second reason is the financial markets are in a constant state of change. They change every day, from month to month, day to day, minute to minute. A lot of it's being driven by news-related items, and markets will literally turn on a dime. I remember just a few weeks ago, and I posted this on the Twitter account, is that after the elections in Wisconsin, there was a feeling that voters might be able to take back their government, and the markets rose 287 points that day. Well, there was no way that when the markets closed the day of the election, that anyone could determine what was going to happen the next day. So a reason to stay in growth is because of the uncertainty of markets, the uncertainty of the economy, the uncertainty of politics. As it changes, markets can move very rapidly. So what you're seeing today may not be what's happening tomorrow. And as many of you have heard me say, the human minds are such that whatever trend we see, we think is going to continue. And this is just not the case in the financial markets. The final reason to maintain growth is the role of governments today. The government would like you to believe that businesses are the ones that are out there creating all the destruction in the markets, when in reality, governments everywhere run and control an economy. They're the ones that print the currency, they control the interest rates, they set the reserves at the banks, they set the taxing policies, and they set the regulations. Today, the governments are playing a bigger role in the markets, and I believe we're at a point where the political news and the political information is trumping the economic. So we've got, in Europe, for example, the solution is going to come from governments because of the debt that's been accumulated at the European level. So what we're seeing then is at any point in time, we have the ability, or the world has the ability for governments to make the right decisions to help the economy that can boost markets. Now, why are they so reluctant to do so? Because these are often not popular strategies. These are strategies that allow businesses and markets to work on their own, and these are not necessarily the strategies that get politicians elected. So this is why we see this struggle, but ultimately, I believe that politicians want to stay in business worldwide and will ultimately make the right decisions. I have taken a very active role. I believe that investments need to be watched on a daily basis. I believe that portfolios need to be adjusted. It's always been my belief that I will search anywhere in the world to find a growth opportunity that can make us money. And it's called a top-down approach. The old buy and hold and forget is just something that doesn't work anymore. You run substantial risk. A lot of investments in securities that years ago you could almost buy and forget, you can't today. Everything is in some state of flux, volatility, with a price change going on. And the mechanics and the fundamentals change sometimes on a daily, weekly, monthly basis. So things have to be watched. And then at the same time, as one condition changes and an opportunity presents itself, that is the way, ultimately, that growth is accomplished. Sometimes it requires a lot of patience, and this is a period where we're at. But it does not change the style that's required in order to capture the returns. So I agree with Mohammed El-Iran at PIMCO that investment philosophy has to be dynamic, it has to be ongoing, it has to be opportunistic. Now, let's follow up to see what could happen the balance of this year. You remember I referenced the chart through May, which showed the sell in May and go away decline. And so the question becomes, gee, where do we go from here? This is a very interesting analysis that, again, is based on seasonality. And this looks at election years from 1900 to 2008, as you can see right here. So it's every 4 years. We've aggregated stock market returns in those election years throughout over 108 years. And this is the pattern that emerges. And what you can see is from the beginning of the year, if you start at the very beginning of January, through April, you see a rise in the market. And then sometime beginning in April, and then extending into May, you see a decline. And then, as the markets bottom towards the end of May, the historic pattern begins to rise in June. And although there's a little sell-off that comes in June, overall, historically, June ends higher than the low point in May. Now, when we talk about seasonality, again, I want to remind you that seasonality is a pattern that has existed in the past. There's no guarantee that today's markets are going to work the same as they have from a seasonal standpoint. However, statistically and on a probability basis, they tend to be a very good indicator. And what this chart tells us then as we look forward in an election year, that markets tend to rise through July, through August. There's a pullback in that September-October period. That usually comes from the belief that, something's going to go wrong, maybe my candidate's not going to get elected. Then it resolves itself out, markets climb up before the election, and then continue to rise, so that we see on a 12-month basis, from the beginning of the year to the end of the year, historically markets have ended higher. For this reason, I kept the portfolios largely intact through the May decline period. Unsettling as it is for you to get your statement, see markets decline, what we're in this for is the entire year. We want to make sure when we sit down at the beginning of next year that we have maximized return for the year. I believe that this is the proper strategy as opposed to trying to outmaneuver each little seasonal decline. So, hopefully you've been able to study this chart and that you understand the philosophy is that we're really rely upon the optimism that tends to emerge in election years. Finally, let's talk about the investment strategy, some ideas that I have. The first one being that everything we invest in is very liquid and is publicly traded with very deep markets. We don't do anything exotic. We don't do anything that is thinly traded or does not have much of a market. The securities that we invest in, we can sell very rapidly and on a moment's notice. The second is I do utilize cash balances. You have noticed throughout the years, the cash balance tends to fluctuate. And I use this as a tool to either reduce the market exposure if I see a period of substantial weakness coming, or to have that cash available to begin to buy areas I like that have suffered through some short-term weaknesses. One of the areas that's exhibiting what's called relative strength, meaning doing very well with everything else doing not so well, is municipal bonds. Many portfolios own these, so I continue to overweight and, in fact, own municipal bonds, sometimes in tax-exempt portfolios, which the interest on municipal bonds is already tax-exempt. So usually there's not a reason to own muni bonds in, say, an IRA account, but because of the strength of the price stability, we do own those. The other area that I believe has strong relative strength is the agricultural. I believe that regardless of what happens in the world, people have to eat. And the second is that worldwide weather patterns continue to change, become very challenging, very difficult, and has the propensity to drive food and agriculture prices higher. So I overweight the portfolios here, seeking the returns that I believe comes from a very basic commodity driven expectation. Lastly, I continue not to recommend financial products that are driven by fear. And some examples are gold, silver, investment products which promise a 6 or 7% rate of return, which in many cases is very illusionary and very deceptive. Any type of this is the end of the world type scenarios I don't believe in. And be very careful because these products and these ideas tend to proliferate in a period where markets are weak. Finally, the number one quote that I have seen of late is, as we're waiting for governments to do the right thing, and there's a lot of unhappiness here in the U.S., that the quote by Winston Churchill that Americans will do the right thing after they've exhausted all the alternatives can be very comforting. And we hope that times have not changed and that this will continue in the future. So this concludes our mid-year update. If you have any questions about what I've talked about, please feel free to call, email myself. You can call Marcy, is also available. I want to remind you that we have a Facebook page now, and we also have a Twitter account. And I'm using now Twitter in placement of a newsletter, to post on a regular basis my ideas and news and information which I believe is that you could use and is important to you. So again, I thank you for tuning in, and I hope to talk to you soon. Bye-bye.